Debt is a common part of modern life, whether it's from credit cards, student loans, or personal loans. Many people find themselves juggling multiple payments each month, which can be overwhelming and stressful. In this video, we'll explore what debt consolidation is, how it works, and when it might be the right solution for you. By the end, you'll have a clear understanding of the basics and be better equipped to make informed financial decisions. Let's start by understanding the challenges of managing multiple debts and why consolidation is often considered. Debt consolidation is a financial strategy that combines multiple debts into a single loan or payment. Instead of keeping track of several creditors, due dates, and interest rates, you make one monthly payment to a new lender or program. This approach can simplify your finances and may even lower your overall interest rate. Debt consolidation is especially popular among those with high-interest credit card balances or several types of unsecured debt. Let's look at how this process actually works in practice. When you consolidate your debts, you essentially take out a new loan or enroll in a program that pays off your existing debts. You then repay the new loan or program with a single monthly payment. The goal is to secure a lower interest rate, reduce your monthly payment, or both. There are several ways to consolidate debt, including personal loans, balance transfer, credit cards, or home equity loans. Each method has its own pros and cons, which we'll discuss in detail in the following scenes. There are several main types of debt consolidation. The most common are personal loans, balance transfer credit cards, and home equity loans or lines of credit. Each option works differently and is suited to different financial situations. Personal loans are unsecured and can be used to pay off various debts. Balance transfer credit cards offer low or zero interest for a set period, while home equity loans use your property as collateral. Understanding these options is key to choosing the right path. A personal loan for debt consolidation is an unsecured loan you use to pay off multiple debts. You borrow a lump sum from a bank, credit union, or online lender, then use that money to pay your creditors. Afterward, you make fixed monthly payments on the new loan, usually at a lower interest rate than your previous debts. This method is straightforward and can help you budget more easily, but approval depends on your credit score and income. Balance transfer credit cards allow you to move high-interest credit card balances to a new card with a low or 0% introductory interest rate. This can save you money on interest if you pay off the balance during the promotional period. However, there may be transfer fees, and if you don't pay off the debt before the intro rate expires, the interest rate can jump significantly. This option is best for those with good credit and a plan to pay off debt quickly. A home equity loan or line of credit lets you borrow against the value of your home to pay off debts. These loans often have lower interest rates because your home is used as collateral. However, this means your house is at risk if you can't make payments. Home equity loans are best for homeowners with significant equity and a stable income. It's important to weigh the risks before using your home to consolidate debt. Debt management plans are offered by nonprofit credit counseling agencies. They negotiate with your creditors to lower interest rates and consolidate payments into one monthly amount. You make payments to the agency, which then pays your creditors. This can simplify your finances and reduce stress, but it may affect your credit and require you to close credit card accounts. It's a good option for those struggling to manage multiple debts. Debt consolidation isn't for everyone. It's best for people with multiple high-interest debts who can qualify for a lower interest rate. If you have a steady income and good credit, consolidation can help you save money and simplify payments. However, if your debt is overwhelming or you struggle with spending, other solutions may be better. Carefully assess your financial situation before deciding. The main benefits of debt consolidation include simplifying your finances, potentially lowering your interest rate, and making it easier to budget. With just one payment to manage, you're less likely to miss due dates or incur late fees. Lower interest rates can help you pay off debt faster and save money over time. For many, the peace of mind that comes with a clear plan is invaluable. While debt consolidation can be helpful, it's not without risks. You might end up paying more in interest if the loan term is extended. Some consolidation methods require fees or collateral, and missing payments can hurt your credit score. It's also important to avoid accumulating new debt after consolidating. Understanding these drawbacks will help you make a more informed decision. Interest rates play a crucial role in debt consolidation. The goal is to secure a lower rate than your current debts. Fixed rates stay the same throughout the loan, while variable rates can change over time. Always compare the annual percentage rate, APR, of your consolidation option to your existing debts. Even a small reduction in interest can make a big difference over the life of the loan. The length of your consolidation loan affects your monthly payment and total interest paid. Shorter terms mean higher payments, but less interest overall. Longer terms lower your monthly payment, but can increase the total cost. Choose a term that fits your budget while minimizing interest. Always read the loan agreement carefully to understand your obligations. Debt consolidation can affect your credit score in several ways. Applying for a new loan may cause a temporary dip due to a hard inquiry. However, making on-time payments and reducing your overall debt can improve your score over time. Closing old accounts or missing payments can hurt your score. It's important to manage your new loan responsibly for the best results. To qualify for a debt consolidation loan or program, lenders typically look at your credit score, income, and debt-to-income ratio. Good credit and steady income increase your chances of approval and better terms. If your credit isn't strong, you may still qualify, but at a higher interest rate. Some nonprofit programs have less strict requirements. Always check eligibility before applying. Applying for debt consolidation usually involves submitting an application, providing financial documents, and undergoing a credit check. Lenders will review your debts, income, and credit history to determine your eligibility and loan terms. The process can be quick for online lenders, while traditional banks may take longer. Be prepared with all necessary paperwork to speed things up. Once approved, the lender will either pay your creditors directly or deposit the loan funds into your account. You'll then use the money to pay off your debts. It's important to follow the lender's instructions to ensure all debts are paid in full. Afterward, you'll begin making payments on your new consolidation loan according to the agreed schedule. Setting up automatic payments for your consolidation loan can help you avoid missed or late payments. Most lenders offer auto-pay options, which may even qualify you for a small interest rate discount. Make sure you have enough funds in your account each month to cover the payment. Staying organized is key to successful debt repayment. After consolidating your debts, it's important to create a budget that ensures you can make your new monthly payment and avoid accumulating more debt. Track your income and expenses and look for areas to cut back if needed. Sticking to a budget will help you stay on track and reach your financial goals faster. One of the biggest risks after consolidating debt is falling back into old habits and accumulating new debt. To avoid this, stop using credit cards or lines of credit unless absolutely necessary. Focus on paying off your consolidation loan before taking on new obligations. Building healthy financial habits is essential for long-term success. Debt consolidation makes sense when you can secure a lower interest rate, reduce your monthly payment, or simplify your finances. It's also a good option if you're struggling to keep track of multiple payments. However, it's important to have a plan to avoid new debt and stick to your repayment schedule. Consider your goals and financial situation before moving forward. Debt consolidation may not be the best choice if you can't qualify for a lower interest rate or if you're likely to accumulate more debt. It's also not ideal for those with very high debt relative to income or if you're considering bankruptcy. In these cases, other solutions like debt settlement or credit counseling may be more appropriate. If debt consolidation isn't right for you, there are other options. Debt settlement involves negotiating with creditors to pay less than you owe, but it can hurt your credit. Bankruptcy is a last resort that wipes out most debts but has serious long-term consequences. Credit counseling can help you create a plan to manage debt without consolidation. Explore all options before deciding. Credit counselors are trained professionals who can help you assess your financial situation and develop a plan to manage debt. They may recommend a debt management plan, budgeting assistance, or other resources. Look for nonprofit agencies with certified counselors. A good counselor will help you understand your options and support you through the process. Unfortunately, there are scams targeting people seeking debt relief. Be wary of companies that guarantee results, charge high upfront fees, or pressure you to act quickly. Always research companies, check reviews, and look for accreditation from organizations like the National Foundation for Credit Counseling. Protect yourself by staying informed. Before signing any consolidation agreement, read the fine print carefully. Look for hidden fees, prepayment penalties, and variable interest rates. Make sure you understand all terms and conditions and don't hesitate to ask questions. Being thorough now can prevent costly surprises later. To determine if debt consolidation will save you money, calculate the total cost of your current debts versus the new loan. Factor in interest rates, fees, and loan terms. Online calculators can help you compare options. If the consolidation loan costs less overall, it may be a good choice. If not, reconsider your options. Some common mistakes include not addressing the root cause of debt, failing to compare offers, and taking on new debt after consolidation. Avoid these pitfalls by being honest about your spending habits, shopping around for the best terms, and committing to a debt-free lifestyle. Learning from others' mistakes can help you succeed. Developing good financial habits is key to staying out of debt after consolidation. Track your spending, stick to a budget, and set financial goals. Consider using budgeting apps or tools to help you stay organized. Over time, These habits will help you build a stronger financial future. Having an emergency fund can prevent you from relying on credit cards or loans when unexpected expenses arise. Aim to save at least 3 to 6 months' worth of living expenses. Start small if needed, and build your fund over time. An emergency fund provides peace of mind and financial security. Regularly monitor your progress toward becoming debt-free, review your loan balance, payment history, and budget each month. Celebrate milestones, like paying off a significant portion of your debt. Tracking progress keeps you motivated and helps you stay on course. Setbacks can happen, such as unexpected expenses or income changes. If you miss a payment, contact your lender immediately to discuss options. Adjust your budget as needed, and stay focused on your long-term goals. Remember, progress isn't always linear, but persistence pays off. When you reach your debt-free goal, take time to celebrate your achievement. Reward yourself in a way that doesn't involve new debt, such as a special meal or a small treat. Reflect on what you've learned and set new financial goals for the future. Success is worth celebrating. After consolidating and paying off debt, focus on long-term financial planning. This includes saving for retirement, investing, and building wealth. Consider meeting with a financial advisor to create a plan tailored to your goals. Staying proactive will help you maintain financial health for years to come. Share your debt consolidation journey with friends or family who may benefit from your experience. Teaching others about smart financial habits can help them avoid common pitfalls and achieve their own goals. Your story could inspire someone else to take control of their finances. Financial products and regulations change over time. Stay informed by reading reputable sources, attending workshops, or following financial news. The more you know, the better equipped you'll be to make smart decisions in the future. Lifelong learning is key to financial success. Regularly review your financial plan to ensure it still fits your needs. Life changes, such as a new job or family situation, may require adjustments. Don't be afraid to update your goals or strategies as needed. Flexibility is important for long-term success. If you're unsure about debt consolidation or financial planning, seek help from a certified financial advisor or credit counselor. Professionals can provide personalized advice and help you navigate complex decisions. Don't hesitate to ask for support when you need it. Debt consolidation loans and programs may come with fees, such as origination fees, balance transfer fees, or annual fees. Always ask about all costs before agreeing to a loan or program. Understanding fees will help you compare options and avoid surprises. Consumers have legal rights when it comes to debt and credit. The Fair Credit Reporting Act and other laws protect you from unfair practices. If you feel your rights have been violated, contact a consumer protection agency or attorney. Knowing your rights can help you avoid scams and resolve disputes. Debt consolidation and refinancing are often confused, but they're different. Consolidation combines multiple debts into one, while refinancing replaces an existing loan with a new one, usually at a better rate. Both can help you save money, but the best choice depends on your situation. Understand the differences before deciding. Some debt consolidation methods, like home equity loans, may have tax implications. Interest on home equity loans may be tax-deductible in certain cases. Consult a tax professional to understand how consolidation could affect your taxes. Being informed helps you avoid surprises at tax time. Paying off debt can be a long journey. Stay motivated by setting small goals, tracking your progress, and rewarding yourself for milestones. Surround yourself with supportive people and remember why you started. Motivation is key to reaching your financial goals. Debt consolidation can be a powerful tool for managing multiple debts, lowering interest rates, and simplifying your finances. However, it's important to understand the risks, compare options, and commit to healthy financial habits. By making informed decisions and staying disciplined, you can achieve financial freedom and peace of mind. Now that you understand how debt consolidation works and when it makes sense, take time to review your own financial situation. Consider your options, seek professional advice if needed, and create a plan that fits your goals. Remember, taking control of your debt is the first step toward a brighter financial future.